Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser with Victory Fiduciary Consulting, and today is July 1st, 2020. Hard to believe, we're already halfway through this crazy year. And so today's the first day of a new quarter, and our kangaroo market environment, it seems like today it's going to remain as much as it has for this past year. And so we've talked before about the fact that this market has been incredibly difficult to trend and kind of to understand what's going on. Is it a bear market? Is it a bull market? And it's a kangaroo market, and with the ups and downs and the constant volatility that we've been seeing. And so CNBC agrees with me. I saw this the other day and took a picture of just the fact that, even very seasoned financial analysts trying to understand exactly what's going on in this market. And so, we've really seen a lot of just short-term variables that are continuing to drive the market. But I really wanted to speak today specifically about what we saw specifically Friday of last week. We had a pretty significant market sell-off. Markets were extremely rattled as continued COVID-19 increases that were beginning to happen across the country, as Florida was coming out with over 9,000 new cases a day, and as well as Arizona and Texas having significant increases in their testing rates. And so we see that this is a chart of the S&P 500. So this red line right here is just the 200 moving day average. And so the moving day average that we chart there is just the long-term trend of the stock. And so if it is trading above that line, we can typically say that it looks like it's in an upward trend. And so when we begin to see, though, an index or a stock begin to break below that moving day average, that's just concerning for weakness. And so we can see that there's been a couple of times we broke it in June 11th, and then we did break it again on Friday. Now this week it's been able to reclaim its spot above the 200 moving day average for now, but again, it's just something that we're watching, that markets are still very uneasy. They're easily swayed and rattled by short-term data that comes out. And so just something that we want to realize, that this is a fluid, changing situation. I've said all along that my biggest concern with this seemingly recovery that we've seen is that the market is priced in an absolute best case scenario and has left absolutely no room for disappointment. And so as more bumps are quite probable along the way, that the market is probably going to need to take a pause and take a breath and kind of digest what that means. And so we saw that on Friday. The Dow was down over 700 points, and then again S&P closing below its 200 moving day average. And so these are things that we need to continue to watch and be mindful as we continue through. We're very early on in, when we talk about economic recovery. So we're in the middle now of earnings season, especially the next couple of weeks. So it'll just be interesting to see as we begin to get actual data, and then the market can kind of begin to process that, and then it'll be interesting to kind of see where we go. And so when we look at just COVID-19's continued impact across the country, you can see, and I'm sure you're aware, that the big story right now is that cases are going up across the country, especially in areas like Texas, Arizona, California, and Florida. They're reporting significant in elevated COVID cases, and so this is just the 7-day moving average. You can see, so we're right now reporting over 40,000 cases a day, which is actually more than we were reporting back at the height when we had basic shutdowns across the country. The one good piece of information for now is that daily deaths is still, the 7-day moving average of daily deaths is still on that trend down. However, this is a lagging indicator. So typically it takes about 2 weeks for this data to begin to kind of catch up to other upticks. And so we do know that for now, a lot of the cases that are being reported are in the younger Americans in their 30s. And so the idea is that this group is probably taking more risks than maybe some other generations would be taking, going to bars, not wearing masks, going to packed beaches, going to nightclubs. But, so that speaks probably to why hospitals are not completely overrun right now. What my concern is, and what I think will be interesting to see, is what community spread, how that will be affected in the coming weeks. So are these people going home, getting tested right away, and then self-isolating, Or are they going to visit family? Are they going to visit friends? Are they going to work? Are they exposing neighbors? And so that type of thing, I think we don't really know. And so those are the types of uncertainties that have left us feeling very cautious all along, that if you price in a perfect situation, leaving no room for disappointment, what happens when bumps come along the way? Something else that's interesting, so Arizona today just reported 88 deaths yesterday in their state, which is a record for them in this. And so that piece of news is a little more alarming. And we know that their ICU beds have definitely, their capacity is starting to be decreased. So we're just going to have to watch and see. And again, the market doesn't care about COVID. The market cares about what COVID's impact is going to be on our economic recovery. And so the concern is if cases continue to rise and then we begin to overwhelm our healthcare systems, then states are going to have to continue to take back steps in terms of their reopening. That's going to affect the recovery. And I think the other piece of this is just the consumer sentiment. Are people going to feel safe to fly? Are they going to feel safe to, go out to dinner and to do the things that we need to spend to kind of infuse money back into the economy? And as we see these flare-ups, I think that there's a growing concern that a lot of Americans will feel pessimistic about that. And so all this is happening. We've seen so much just, I've given you a lot of negative just data in general, just giving you factual information, and yet it seems like the stock market continues to not care. And so we know that we're currently on track to have our most volatile year in 70 years. Currently we are trading 55% of our trading days are considered outside days. So an outside day is anytime the market begins 1% higher or lower than where we started. A typical year, 24% would be considered an outside day. So we're right now trading 55% outside days, extremely volatile, the most volatile year we've had in 70 years so far. And again, it's just a sign of a market that's not healthy. It's a sign of a market that's irrational, and it is just a very difficult place for a long-term investor to be. Our Buffett indicator, so that is the indicator that tells us if the stock market is generally overvalued or undervalued, is at over 146%, which puts us significantly overvalued. We're literally at levels that we haven't seen since the dot-com bubble burst. And so that's where we're sitting. That's why Warren Buffett is still sitting on $137 billion of cash. And so, we look at the S&P 500, that coming into 2020, we were using earnings assumptions of $160 per share. Well, we're now pricing it over $180 per share. And so that seems really difficult to wrap our heads around, because that means that since January, our earnings had to have increased that much to be able to support valuations of that. And we know that that is not the case. And so at some point, there's going to have to be a reconciliation there. And typically history shows us is it's not that values come up to meet, or earnings come up to meet the values. Valuations always wind up having to trend down eventually. And so, we just seem to be in a market right now that is extremely detached from reality. It's emotional, it's exuberant. And so we saw that even this morning. And so this morning when I woke up and I checked the Dow Jones futures, they were down over 250 points. Everything was looking, we went open probably pretty negative today. Makes sense with a lot of the information we're getting regarding the economy and states needing to backtrack. New Jersey is one of those states that had to decide that they were not going to open up indoor dining this week like they were supposed to because of these spikes that we're seeing. That's going to negatively hurt our hospitality sector in New Jersey, certainly. And so all of a sudden this morning, about half an hour before the market opened, Pfizer came out and said, hey, we had a really positive initial study. It's not been peer reviewed yet. No medical journals have looked at it, but we had some positive feedback after we had this very, very short study. There were some pretty negative side effects that happened with some of the participants, but some of them did respond and have a response against COVID. And so this is the third or fourth time that I can think of that the market kind of rallied off from having kind of a negative day to a positive. And again, this is that we're going back to that riding on hopium mentality. So the vaccine that they're talking about today, and just so you know, those other vaccines that they talked about, very quietly a couple of weeks later, a lot of times the news wasn't as good as they try to get into second and third trials. They kind of had to go back to the drawing board. So for where we are right now and for the foreseeable future, this news probably won't make that big of an impact. But for the market, it was kind of like all it needed to kind of be able to try to have a little bit of a rally. And so just an example of how we just kind of continue to see these day-to-day fluctuations. And so what do we do then? So as an investor who's responsible for investing my clients' assets, how do I invest? And I can say very definitively that the one way we absolutely do not invest is using emotion to guide us. Really the key in a market that is as volatile and exuberant and emotional as it is, the only way to really survive this long term is to be able to remain unemotional. Because when we allow our emotions to drive our decisions, in the end, we will probably be very disappointed by what happens. And so we are sticking with our math and rules-based process. And so these are our 6 long-term indicators. We just had another investment committee meeting today. Very little is unchanged at this point. Our short-term indicators remain to be positive. Our 2 long-term indicators remain negative, and we continue to give our intermediate chart there, dynamic asset level investing, we give it a caution. And that's because even in Dolly, which really just looks at all the different asset classes and sectors and says, hey, where's our best opportunity to put money in right now under current market conditions? Well, right now in Dolly, cash is the #1 position, fixed income is #2, with domestic equities being #3. And so we give it caution because domestic equities has improved a little bit, but we're still saying that fixed income and cash are better opportunities. And so for us, that's why we remain cautious. That's why for individual clients, we're using fixed income and cash type vehicles for investments for now. And because the idea is this, as a long-term investor, we need to know what is our risk versus reward. And so right now in the market, it still stands that being in equities, the risk would outweigh the reward for now. And so we are eager to re-enter the market when those symbols that we track and our indicators and our charts can show us that it would be more favorable, especially over the long run. And again, we just want to remain non-emotional. We know that in the end, math wins. And so that's where we are. So it's been an interesting week so far. It's only Wednesday. It's going to be a short week trading-wise. Markets are closed on Friday. And so thank you for joining us. And, we're just looking forward to seeing what's going to happen over these next couple weeks within the market. It's very fluid and changing. But, we're looking forward to being able to just kind of see what the second half of the year is going to bring. And so here at Victory, we wish you and your family well. We pray that you remain safe. Have a great, happy 4th of July, happy Independence Day. And we look forward to seeing you next week. Thank you so much.